And Julian Brigden, welcome back to F.A.C.E. Were you busy trading the NFP? Julian, how are you? I'm asking you to unmute. Waiting to hear you, my trading warrior brother. You have to do something with your audio.
He is still muted, isn't he?
I mean,
well, there you go.
There you go.
Can you hear me? Perfect.
Yeah,
Sorry about that, guys. I could see the screen with all your prices and stuff, and I couldn't for the life of me see where I unmuted.
All right.
No, I mean, I think, it's a bit of a nothing, that non-farm payroll, to be brutally honest. I mean, it was robust. We know the trend is for slowing data, right? There's definitely some signs on the margin that the Fed has managed to sort of soften this labor market growth. But I don't think it's enough. I mean, on balance, and you can see this in the market, people are like, oh, does this shift us from 50 to 75? I really give a
think
shit?
70, don't you think 75 is baked in after Moses came down from the mountain at Jackson Hole?
No, I mean, I think, look, 75 is, I think you've got to think of it like this. It's, from a policy perspective, right, you're trying to turn a super tanker, okay?
Yeah.
It really doesn't matter, Dale, whether you do 75 or 50 or even 25, right? We all get our knickers in a twist about this. We all get all so excited. Pivot.
So is QT more important, Julian?
No, I think ultimately where rates go is more important, right? So they can go 75, 50, 25, 25. They could go 50, 50, 50, 25. They don't give a shit, right? 75 is kind of an emergency measure. 50 is the new 25, for want of a better term, but it's still, somewhat aggressive. But really what matters is where they're going and then what happens. And then to your point, I do think that QT is more important.
Okay.
I do think that QT is more important. So
yeah,
I think we're going to 375, maybe 4. Then I think they've made it very clear that their plan doesn't mean it actually pans out like this, Dale, right? That's how we make our money, is betting against these guys in many respects. But their plan is that rates sit there at what they would call mildly restrictive, okay, for an extended period of time, right? This is what the last few months have been all about. It's been pushing back against the assumptions of the bond market that we would see rates immediately get cut. Okay?
Well, I think that was crazy, but you're not going to go from tightening to cutting. You're going to go from tightening to standing.
Well, you could if you break the equity market, right? And I think ultimately that's what the bond market has been pricing. Okay.
Okay. So if it's all about the S&Ps.
Yeah, I mean, if you really put a gun to the bond market's head, right? If you look at, say, real yields or something like that, right? Yeah. I mean, there is a massive divergence between what is priced into the market's view of real yields, which is tips basically, and actual real yields. If you look at, say, the 2-year differential. So if you want me to, can I share a screen on here, Dale?
Oh, yeah, that'd be great. So I'll stop sharing, and it's at the bottom of your screen, Julian.
Yep. Okay, hold on one second.
So how are you advising your subscribers to deploy capital in an environment like this? Where are they hiding?
Short stocks.
Just short, okay.
Yeah, I'm short at the moment.
Okay.
So, where's that? Bloomberg. What the hell, Bloomberg doing? Sorry, hold on one sec.
There. Okay, I see a Bloomberg thing.
Yeah, it just threw a wobbler.
Is that a cricket term?
Yes.
We call them knuckleballs here in America.
Yeah, exactly. So, okay. screen. Okay. So here you've got tips. Okay, this is kind of the market view on real yields, and here's actual real yields versus CPI. And remember, tips are calculated off this. So there is a 600 basis point differential between the two. Okay, wow. I mean, typically, you know, you can see here between like in 08 and then in 2011, it was, in fairness, this that corrected as CPI fell, right? But that's a hell of a correction in CPI you're factoring in over the next 2 years, right? 600 basis points. So the bond market is fully on side that the Fed's getting the target down to 2%. But you could ask yourself, how do you realistically get that? I mean, you know, does suddenly energy go massively negative? What else could happen? I think really what the bond market is telling you is they're kind of thinking the Fed is going to massively overcook this thing. They're going to break something. But what do they have to break? They have to break the equity market. And the problem there is it hasn't really broken yet, Dale. Right? And we're down. We're not out, mate.
Do you have a level?
Close. Yeah, 3,000.
Okay,
on the
that
S&P.
would be it. Okay. All right, so that's right around the pre-COVID highs, 3,100 or so.
Yeah, something like that. Yeah.
And that would be your definition of a broken, that the Fed
will
I
think that would
nervous.
do enough to damage the economy, right? I think that would do enough to damage the economy, given what I refer to as hyper-financialization. Okay. In other words, this correlation between the real economy and the equity market, which is basically 1-for-1, where in a bizarre way, you would think that the real economy would lead the equity market as a deriver of, profits and growth, et cetera, but it's actually the other way around because of the behavior of CEOs who are only paid to support the equity price. And so the minute the equity price starts to falter, they go and start cutting costs and employment. And we've seen that with all these tech firms, right?
Yeah, beginning to see it. So go ahead.
You basically have to get this equity market down. I think the Fed has to get this down. And today's number is just, I guess, is slightly welcome news. But 300,000 is still double trend, right?
Isn't it backward number?
Yeah,
or do you consider it pretty real time?
No, it's backward. It's backward.
Yeah.
Right, but
so
some of the
Fed
real
be tightening
stuff,
into looking at backward indicators, and again, not looking forward to when Fed policy finally filters through.
Yeah,
the
sure,
economy?
But that's the nature of the beast, right? That's why their plan is to try and stop at 375 and 4, right? I mean, look, if they were real, if they were meaningful, if it's like, we have to get rates above inflation.
Yeah.
Right, we'd be going at 8. Right, well, they're not. Right,
because we're still at negative rates.
Lags.
Yeah, because these are still negative rates, even at 3.5, 4.
I mean, look at this. It's 2 years. It's minus 500 basis points.
Yeah. So it's more jawboning than anything else, isn't it?
Well, I mean, I think it's they are trying to pursue what is, in central bank terms, referred to as opportunistic disinflation. Right, this is a policy that Greenspan followed in the mid-90s. We've never done it from this higher wire before, right? So it might not work, okay? But it's the only pleasant way to bring this thing, pleasant in inverted commas, to bring this thing to earth, okay? And that is, you raise your rates to whatever the number is, okay? You then leave them there, and policy essentially becomes asymmetric, whereby economic weakness and inflation weakness is not acknowledged, right? You don't cut, right? GDP comes in weak, inflation drops. You sit there for a long, long period of time.
Okay.
And you let growth and inflation comes to you, okay? Or the odds. And if inflation and growth don't, you hike aggressively again. So policy literally becomes asymmetric. And yeah, I mean, that's what they're hoping. Who's to say whether they can achieve it? I think a lot will have to do with the £1,000 gorilla in the room, and that's
the dollar.
QT.
So there's no sign of any shift in trend to a very crowded trade on the long side of the dollar.
I mean, I think positions are crowded. But I'm just, I'm writing a piece now for my clients for sort of Q4, and I'm just going through this European stuff, Dale.
Yeah.
I mean, it's dire.
Yeah.
Right. It's dire. I mean, I think, you could say there's a lot in the price. I mean, there's stuff in the price. I mean, but there's not a lot in the price. I mean, I think I was just reviewing some of the comments we got yesterday in the S&P Eurozone Composite PMI, right? And there were a couple of lines in there that comments from the chief economist, which I think were just chilling. I mean, the guy basically, I'm seeing if I can find it.
Well, there are people talking about there, actually could be starvation.
No, I mean, this is what he said, right? I mean, this is what I fear is coming slightly to the US as well. But he said, falling sales are not only increasing the number of factories to cutting production, but have also meant warehouses are filling with unsold stock to a degree unprecedented in the survey's 25-year history. Weak demand and the efforts to reduce high inventory levels are therefore combining to drive production lower in the month ahead, right? The orders to inventory ratio, an important indicator of future production, is in fact now signaling a downturn of intensity not seen since 2009, barring the initial pandemic lockdown months. So I think, we're looking at some of these PMIs. They look weak, okay, but they're not horrible in Europe. But I fear these are Wile E. Coyote. We're at a Wile E. Coyote moment.
On the ledge.
On the ledge, right? And it's going to look all right. We've got the setting sun of a nice summer in Europe. Packed. The place is packed. Okay, yeah. With American and foreign tourists because the exchange rate is ridiculously cheap. Yeah. Okay, but come October, November, unless you see consumer confidence bounce, which by the way is at 35-year lows in Europe, these numbers are just going to implode, and consumer confidence is going to lead business confidence, which is what it did in 2009 and the sovereign crisis of 2011 and 2012. Okay, and then, then the euro, I think, does go. That's what I fear.
The euro is no more or collapses?
No, I mean, I think it drops to the
80?
bottom of the bottom of the channel. I mean, I don't have an FX position here because I think it's just everything's a little noisy. And my bigger focus has been on trading the equity market.
Okay.
But to me, unless you can get above, I mean, you're the far better chartist than me, but the one that I'm looking at.
See, I was looking for you to tell me if you could come up with any fundamental reason why the euro could rally. Can you think of anything, Julian?
Well, I mean, you are getting a tougher. I mean, there's some positioning elements. There are some positioning elements where the market's a little short.
The
ECB
those are like technical.
Yeah, the ECB is stepping up their game. 75 is the base case next week, right?
Yeah.
But I really struggle to come up with a fundamental reason, right? And it looks to me that technically, I mean, you're sharing your screen, but mine's actually, I think, if you let me share, I'll see. And I'd love to your input, right? You're the better technical guy. So if you stop sharing, let me share.
Okay.
Okay. This is what I've been watching, just to cut the noise out.
Okay. Yeah. All right. Pretty ugly. Yeah.
I mean, head and shoulders.
Yeah.
Neckline, unless you can get above 103.5.
I agree. That's
You
when
know,
and that's when people will begin to embrace it. That was a big area, got rejected when it tried it a week or so
yeah,
ago. I agree. And then I also agree with your 109, 108.50 level.
yeah,
Should we get over 103.5, I think we get up to your red number.
yeah.
That's my
But otherwise,
analysis.
barring that, I think we're heading kind of to these 2001, 2002
The inception,
lows, right?
back to where it all started, full
Back
circle.
to where it all started.
Okay, so are there any particular sectors, or are you just doing indices, and any area in the world that looks more vulnerable as far as playing the short side of
Oh, and
equities?
stocks? Yeah,
Yeah,
I mean the one that I really think is potentially ugly is housing in the US.
okay.
I think on a relative basis, I think people do not understand what's coming down the pipeline in terms of this housing slowdown.
Well, let me ask you this, the counter argument.
Yeah,
And part of the rationalization, people then say, well, housing prices are going bananas because the Fed's buying MBSs out there,
yep.
kazoo. The bull's argument was housing stock shortage. So how do we go, since you have to build them, how do we go from a housing stock shortage to a housing stock glut?
So, look, I mean, that's a valid structural argument. There's lots of people who'd like to buy a home, right?
Yeah.
But the desire to buy has nothing to do with the action to buy. Ultimately, the action to buy is one of affordability. And affordability is appalling. So you can sit there, sitting in your mum's basement, desperately wanting to buy a home, but if you can't afford it, tough shit.
Yeah.
Right? Just tough shit.
And your mom's basement you're renting it at a pretty good price. Plus,
You're
she
probably
cooks.
renting it a decent, yeah, and does your washing, right?
Yeah, I mean, if my mom was still around, I'd think about it.
Yeah, exactly.
So let me ask you this: any fiat currencies that you like against a dollar?
Not
Your
here,
view on
not at the
inflation?
moment. Not at the
Not
moment. I
Aussie,
think
nothing.
no. I think you can't look, Dale. I think we're going to get to a point where the rate of change of the dollar, and we're inching there, is historically associated with a crisis, right? I mean, it's actually very, very clear if you go back and you look at the history and you look at the rate of change, not the level so much actually. It is the rate of change of the dollar, where typically you get a crisis, right? Something breaks. Could be, we walk in one day and the equity market in the US has dropped another 20, 25%, right? And the Fed backs off. It could be that the euro drops to 80 and the ECB and the Bank of England are screaming at the Fed to do something, right?
Won't the Fed backstop Europe if there's a problem?
No, I mean the ECB can backstop themselves, but the point is, there might be a point where it starts to cause systemic problems, and that's what you're looking for, right? You're looking at a rise in the dollar that causes a systemic crisis, and that's when it turns, because the Fed goes, "Oops, sorry," they back off, and that's when you buy everything that you and I have talked about wanting to buy
for the last year. Yeah,
I mean, last few years, right? Ultimately, this is the end game. The problem is this time the pain threshold is going to be materially worse than we have seen at any point since the GFC, right?
Okay, so could it be an Italian bank or a banking crisis in Europe? How about China?
Yeah, I mean, it could be. There's a bunch. It doesn't, it's typically a few things that go. I don't know exactly what the exact stress point is, right? I still, as I said, I mean, I look at the US equity market, it looks dire, to me, the setup. I mean, I think people are absolutely smoking crack if they think that Apple is a place to hide out if Europe which is a market of 300 million wealthy consumers, are going to keep buying, 1,000, 1,200 euro iPhones, if they go into a downturn, the like of which I think we're going to see, right? I mean, I think all of these things just look overvalued. And what will give me the trigger is the price action, right? But I suspect it would take for this dollar really to back off and the Fed to really back off. You're probably looking at a euro at those low 80 lows, right?
Okay. So the major narrative I'm getting from you, Julian, as we wrap up is let's take a little more of a telescopic view, is that this bounce that we had this summer is terminating, and that where this is the resumption of the bear market that should take out the June lows and continue till about 3,000 when the Fed starts getting concerned.
Yeah, I mean, look, I use some simple little metrics, simple moving averages.
Simple is powerful to me, bro.
It is, mate. Yeah, it is. It absolutely. Yeah. And those crossed in April, and I got a sell signal, and on the S&P, and I went with it, and then I covered a bunch of stuff back in early summer. Yeah. And I said, typically you can move back up to those moving averages, and we did. We came right back up to, some of my moving averages, and so
200-day capped it.
2 weeks ago, we slotted a bunch of, we bought downside puts for November and December at 3,800, and we slotted the S&P, and that to me just seems like the cleanest trade out there. I mean, right here, right now. I think it'll come down to QT, right? I mean, the Fed has not done as much QT as they suggested they would, in part because they've had problems with the mortgage portfolio. I thought it was interesting yesterday that Bostic talked about how they may have to hit the bid in mortgages, that they can't just rely on, prepayments, which obviously aren't happening at the moment, given where rates are, causing the balance sheet to run off, that they may actually have to start hitting the bid. And I think, 3,900 is what my liquidity model suggests is kind of currently fair value for the S&P. But as we know, next month, QT doubles, right? So are you
okay? So are you bearish enough the housing market to sell your house? In
I'm keeping that one. It carries kind of well, so I'm keeping that one, Dale.
Okay. But rental properties.
Yeah, I mean, I would be. What I'm looking for really is not an 08 style bust. What I'm looking for is a collapse in housing construction. Okay, so the sort of thing that you saw in early 70s, early 80s, early 90s, where sort of new home building goes from like 2 million to 1 million. Okay.
Yeah.
And that's enough to give you typically a pretty nasty recession on its own. Add in a very ugly inventory cycle, which I talked about, you're already seeing in Europe. I think you're going to see a recession. Are we there yet? Absolutely not. Does the Fed have to probably keep doing more? Almost certainly. And that's why I think we're still in this sell risk rallies and wait for something to break, right? And the dollar is typically the wrecking ball. It's the napalm in the napalm run, right? It's a risk-off dollar rally I refer to it as a napalm run.
I love the smell of napalm in the morning.
Correct.
It reminds me of victory.
True. Well, in this case, yeah, if you're short. But that's the reality, right? I mean, a risk-off dollar rally is the real killer, because most assets are denominated in dollars, so they're falling anyway because you're in a risk-off environment, and then the denominator is rising, and so you're turbocharging the decline, right? It's really, really vicious, and left to its own devices, all you're left with is a bunch of smoking holes and charred bodies, right? And so that's when you look to take advantage, but we aren't there yet. No. I mean, there's no signs of capitulation in this equity market. Why? How can you capitulate and put the low in with the VIX in the 20s, for Christ's sake, right?
Yeah. Yeah. I mean, this whole cycle, we never got above 40.
No, not even close.
We really never had it. It was almost orderly, the decline, instead of chaotic, right?
Yeah, and I think that was because, and I think we saw the consequences of that. You know, I was looking at it back in early summer, and it was amazing me. I mean, long short equity or equity hedge funds are generally don't outperform the market, right? Particularly in a down market, right? They actually underperform because these guys are usually balls to the wall long, right? And leveraged. For the first time in God knows how many years, they actually outperformed, right? They actually outperformed, which told me that the pros had hedged successfully into the first leg of the downturn. We then get the squeeze as a result of them hedging, and retail or high net worth hadn't sold at all. Not at all. Not at all. So there's no capitulation in my mind.
Okay, so Julian, what a great day to have you, as Blake said, with the NFP, and I root for you. I'm a fan, and
thank you, sir.
And here's where people can find you and your excellent elite analysis. And I didn't interrupt you as much as I usually interrupt people because I learned from you today, and I really appreciate you coming here to edify our community, and hope that all of your trading objectives are accomplished.
Well, let's hope so, Dale. Yes, that's what we have to. That's what we have to listen to, and hopeful. And look, if anyone wants to follow me at JulianMI2 on Twitter, is probably a good way. And then just ping if you are interested in subscribing either to the institutional stuff or to the macro insider stuff that I do for the retail guys. Just ping us on the website, and we'll get back to you. Thank you very much.
All right, thank you for the clarity, my trading warrior brother. Appreciate it.
Pleasure, sir.
All right, that Julian Brigden, everybody, follow him, check him out, and have a great weekend, everyone. Could join the team in 15 minutes for the morning edge. I'm calling it a day. Good hunting the rest of the day, and most of all, everyone, don't just count your pips, count your blessings. You're hearing about people that can't pay their utility bill, and here you are gambling and speculating. Acknowledge that you're in a better position than a lot of people in the world to assume risk when they're trying to balance a decision between food, electricity, and medicine. And that's all I have to say. Have a great weekend, everyone. Thanks again, Julian.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.